Welcome back to the Deep Dive. Today, we're plunging into a topic that, well, it might seem a bit specific at first glance, but honestly, it's absolutely central to how businesses actually run. And it's full of fascinating twists. We're talking about this sort of silent revolution happening in financial accounting and auditing, all thanks to computerized accounting systems.
Right.
And look, this isn't just theory, okay? These changes are directly shaking up professional qualifications. We're talking Financial Accounting, FA, from September 2023, Foundations in Audit, FAU, from December 2023, and Audit and Assurance, AA, coming up in September 2024.
Exactly. And our mission for you today really is to cut through all that noise and truly connect the dots.
Yeah.
We want to show you exactly how these crucial shifts impact both financial accounting and audit, give you a clear understanding of what's important, why it's important, and maybe most crucially, where human oversight is still absolutely vital in this increasingly automated world.
So here's where it gets really interesting right from the start. We've got this amazing tech automating so much, but at the heart of computerized accounting, there's this core distinction. Which processes are truly fully integrated with the system and which ones still demand that human touch?
Right.
So we're going to dive into two key categories that are just crucial for your understanding. Processes that are always fully integrated and those that remain a manual process, at least in the context of the ACCA qualifications.
Precisely. And think of fully integrated, like, I don't know, a smart home system, maybe.
Okay.
You tell it to turn on the lights, it automatically updates the energy log, probably adjusts the thermostat, all without you doing anything else.
Right. Just seamless.
Exactly. So in accounting terms, that means any invoice, any financial entry, let's say a sales invoice, it's automatically recognized in the general ledger.
Instantly.
Pretty much. And it doesn't just stop there. It also instantly updates all the detailed individual customer or supplier accounts. It's a seamless real-time update. Now compare that to a manual process. Here, even with a computerized system, you still need a specific human-initiated journal entry to make that recognition happen in the general ledger. The system won't just, do it on its own.
Okay, that makes sense.
Yeah.
So if the system's doing the heavy lifting, what are those processes it handles almost entirely by itself? What are the big hitters that are always fully integrated?
Well, the primary ones, really the high volume daily transactions, the sort of bread and butter for most businesses, that's going to be your sales of goods and services on credit and your purchases of goods and services on credit. The system is really designed to automate those flows, pretty much from start to finish on the accounting side.
Got it. Credit sales, credit purchases. And then what about the other side of the coin? Where do we, the humans, still need to step in and make sure everything's captured correctly, even with all this powerful tech?
That's a critical question. And generally, these are processes that need some kind of external check, or maybe they're just less routine. So in the ACCA context, the generally manual processes include anything to do with bank and cash.
Okay.
And that covers all receipts and payments.
Yeah.
Even cash sales and purchases.
Even cash sales. Interesting.
Yes. Also, disposals and purchases of non-current assets, big ticket items usually fall squarely into this manual bucket.
Right.
Payroll is another big one. It's typically a weekly or maybe monthly manual journal entry process. And this is important. It means those payroll reports, they are not automatically reconciled to the general ledger by the system itself.
Wow. Okay. So someone's manually posting that payroll summary.
Correct. And finally, inventories are generally a manual process too, specifically for the transfers to cost of sales and updating the inventories account itself. Now, there's a small but important caveat here.
Okay.
An exam question might specify an integrated system for checking inventory levels, but that's different from the accounting entries, right? That's more about identifying errors in FA or spotting controls and deficiencies in FAU or AA.
That's a vital distinction. Yeah, it really reshapes how you think about what computerized truly means in practice.
Yeah.
So, okay, let's trace a transaction now. Let's follow it from the very beginning to the end and see this distinction play out. Let's start with a credit sale. Where does the system take over and where do those manual steps remain absolutely essential?
Perfect example. So for a credit sale, the early steps like a customer placing an order or goods being dispatched from the warehouse, these are managed within the sales module.
Right.
Warehouse staff might create a goods dispatched note, a GDN, in the sales module, and the system often does a two-way match here.
Two-way match. What's that checking?
Think of it like a quick internal cross-reference. The system is just checking that the customer's order matches what's actually being shipped out. Simple check. But here's the crucial part. At this stage, No accounting entries are generated.
Not at all.
Nope. It's still just an operational record at this point.
So the goods are out the door, the system knows they've gone, but the financial story hasn't actually started in the books yet.
Exactly. The aha moment, the trigger for the accounting entries, happens later, once delivery is confirmed, and then the accounting staff actually create the sales invoice in the sales module. That's the trigger.
Okay, the invoice creation.
Yes. The system then performs a three-way match. And this is a critical control step. It's checking that the sales invoice, the original customer order, and that goods dispatched note all align perfectly.
Invoice, order, GDN. Got it.
If they do, boom. The system automatically recognizes the sale, the trade receivable, the money owed by the customer, and any related sales tax, all in the general ledger. And simultaneously, it updates the individual customer account in the detailed listing, the sales ledger.
Fully automatic at that point.
Correct. But now here's where we pivot back to the human element, the actual receipt of cash from that customer.
The cash.
That's a manual process. Accounting staff will need to check the remittance advice, the note saying what the customer intended to pay against the actual bank statement.
Right, verifying the funds.
Exactly. Only then do they process a manual journal entry to update trade receivables and the bank account. And the individual customer account in the sales ledger is then also manually updated to show the payment.
So this raises that important question you mentioned earlier. Why isn't bank and cash integrated even when the sales side is?
Well, it really comes down to control and verification against an external source. The flow of actual cash, whether it's coming in or going out, demands direct human verification against something like that bank statement. There's just an inherent risk in trusting a purely automated reconciliation without human eyes confirming the actual cash movement.
That's a huge insight. Really is.
Yeah.
So the system handles creating the debt automatically, but the moment real money changes hands, it's back to human verification. Makes sense. What about returns if a customer sends goods back?
Good point. It depends. If a credit note is issued from the sales module for a return, say the goods were faulty, the system will automatically recognize the sales return and update the trade receivables and sales tax.
Okay, so the reversal is automated.
If it's just a credit note, yes. But if that return involves actually giving a refund back to the customer...
cash going out.
Exactly. That, again, requires a separate human-keyed manual journal entry to update the trade receivables and the bank. It's that cash element, again, needing manual control.
Fascinating. It truly highlights the human-in-the-loop role, especially for managing the actual cash flow. Now, let's flip that coin and look at credit purchases. I imagine we'll see some parallels, but maybe some key differences too, looking at it from the other side.
Indeed, there are strong parallels. For credit purchases, it's very similar to sales in the early stages. Steps like creating a purchase requisition, sending the order off to a supplier, receiving the goods. These are all processed within the purchases module. When warehouse staff create a goods received note, or GRN, in the purchases module, often a two-way match happens again, just verifying the purchase order against the goods actually received.
Just an internal check.
Correct. But just like with sales, no accounting entries are generated at these early stages. The accounting impact waits.
So, same pattern. When does that crucial accounting recognition happen for a purchase then?
It happens when the supplier invoice finally arrives and is processed. Once accounting staff input that invoice into the purchases module, the system then automatically performs its three-way match.
Okay, what's it matching this time?
Here, it's diligently checking that the supplier's invoice matches your internal purchase order and that it also matches the goods received note. Invoice, PO, GRN.
Got it.
If they all agree, the system automatically recognizes the purchase, the trade payable, the money you owe the supplier, and any related sales tax in the general ledger. And of course, it simultaneously updates the individual supplier account in the detailed purchases ledger listing.
Automatic again for creating the liability.
Precisely. And mirroring sales, the actual payment to a supplier is a manual procedure.
Makes sense. Cash going out again.
Exactly. Accounting staff process those payments, maybe via online banking or check, and then they make a direct manual posting, a journal entry to update trade payables and the bank account. The individual supplier account is then also updated by hand to show it's paid.
Okay. And returns on the purchase side, if we send goods back.
Similar logic. When a credit note from the supplier is received and input into the purchases module, the system will automatically recognize the purchase return and update the trade payables and any related sales tax.
Automatic reversal of the payable.
Yes, but if your company receives a refund from the supplier, actual cash coming back in,
Manual entry.
you got it. That will require a separate manual accounting adjustment to update trade payables and the bank. Oh, and just a quick terminology note. Sometimes that credit note you receive from a supplier is also referred to as a debit note.
Oh, good to know. Different name, same idea.
Same financial outcome, yes.
Okay, so we've navigated the high-volume, often automated world of credit sales and purchases and the manual cash aspects.
Right.
But what about those less frequent, but often much higher value transactions? Things like buying or selling big assets or just managing the overall flow of cash itself.
Yeah.
This is where I suspect the human element becomes even more critical.
You're absolutely right. These are precisely the areas where manual interventions aren't just common. They're often deliberate control points. Take non-current assets, things like property, plant, equipment.
Yeah, the big stuff.
When a company disposes of an asset, sells it, accounting staff will actually manually issue a sales invoice for that asset's delivery. But crucially, this invoice is not input into the normal sales module.
Why not?
Because under IFRS accounting standards, selling a piece of equipment isn't considered a typical sale of goods in the same way as selling your normal inventory.
Okay, different classification.
Exactly. And because these non-current assets typically aren't integrated into that daily sales purchases flow, a specific manual journal entry is then processed. This updates the trade receivable, or the bank. It adjusts the non-current asset cost account and the related accumulated depreciation, and it records any gain or loss on that disposal.
A lot of moving parts in that one entry.
There are. And crucially, the non-current asset register itself, the detailed list of all assets must also be manually updated. It's not an automatic link.
Right, someone has to physically remove it from the register.
Or mark it as disposed, yes.
Yeah.
And it's similar for purchases of non-current assets. Accounting staff manually record the asset using the purchase invoice. Again, this invoice isn't usually put into the standard purchases module because it's not a regular purchase of goods or services under IFRS.
Same reasoning.
Same reasoning. So a specific human-keyed entry is processed to update the trade payable or the bank and the non-current asset cost account. And yes, the non-current asset register also needs that separate manual update.
Manually adding the new asset.
Correct. And just a quick reminder, that asset only starts being depreciated once it's actually ready for use, not necessarily the moment you buy it.
Got it. So it really feels like the system handles the routine, the repetitive stuff, but when something unique or high value happens, it kind of kicks it over to a human for careful oversight. That makes intuitive sense.
It does, doesn't it? It's about focusing human effort where judgment and verification are most needed.
Okay. And what about bank and cash, our final major manual category? We touched on it, but let's just nail that down.
Absolutely. We've touched on why cash is predominantly manual, but just to reinforce, for cash receipts, accounting staff verify them. They look at remittance advice or bank statements.
The external proof.
Yes. And since the bank and cash accounts are typically not integrated for automatic recognition of these movements, a manual accounting adjustment, a journal entry, is processed. This updates the bank or cash GL account and the corresponding other GL account, maybe trade receivables, maybe cash sales, maybe the proceeds from selling that non-current asset we just talked about. And it's the same logic for payments. Accounting staff initiate them, authorize them, and then a manual record update is processed to reflect that payment in the bank or cash account and debit the relevant GL account, like trade payables, direct purchases, other expenses, or payments for non-current assets. It's always that direct human verification against bank records that's paramount for cash.
Wow. Okay. We've really covered some ground there. We've gone from the highly automated processes of credit sales and purchases, explored the nuances of returns and refunds where cash changes hands, all the way to the critical manual interventions for bank, cash, and those often high-value non-current assets. I really hope for you listening, you now have a much clearer understanding of where the computerized system truly takes over, and crucially, where human intervention remains absolutely vital, not just as a fallback, but actually as a deliberate control.
Yeah, and if we connect this to the bigger picture, understanding where these manual entries happen, even within a largely automated system, is absolutely crucial. It helps you identify potential control points or maybe areas of risk. And this is particularly relevant, I think, for those of you studying audit, because these are often the very areas where an auditor would focus their attention, looking for mistakes, anomalies, or weaknesses in the process.
That makes perfect sense. And that leads us nicely to our final provocative thought for you today. Given everything we've unpacked, the automated flows, the crucial manual checkpoints, the reasons behind them, How might this insight reshape your perspective on ensuring data accuracy in a world that's increasingly reliant on technology? Whether you're prepping for a critical meeting, studying for those exams we mentioned, or maybe just trying to stay well-informed about how businesses really work, how does knowing where those human hands are still very much involved change your approach? That's something to think about. Thanks for deep diving with us.